Every financial crisis follows the same script. Markets collapse, governments panic, and a small group of families steps in to buy what everyone else is forced to sell. They loan money when no one else can. They acquire assets at fractions of their worth, and when the dust settles, they own more than they did before. This isn't opportunism, this is a playbook, a repeating pattern across 4 centuries where national emergencies become wealth consolidation events for those who know the crisis is coming, or better yet, helped create the conditions that made it inevitable. Let me show you how a handful of elite families have turned every crash, every war, every panic into a mechanism for transferring wealth and power upward. The pattern is so consistent you can predict it, and once you see it, you'll understand why the next crisis won't impoverish everyone equally. It will devastate the middle class and enrich the top. The playbook has 5 moves. First, create the conditions for instability through debt expansion and financial complexity. Second, position yourself in advance with cash, gold, or privileged access to credit. Third, let the crisis unfold while governments scramble. Fourth, provide the solution. Loans, bailouts, liquidity, always at a price. Fifth, acquire assets at distressed prices and lock in structural advantages that persist for generations. This isn't theory. This is documented history. The meetings happened. The contracts exist. The wealth transfers are in the historical record. And the families who perfected this playbook are still operating today. Different names, same method. Start with the panic of 1720, the South Sea bubble in Britain and the Mississippi bubble in France. Both were speculative manias driven by new financial instruments, joint stock companies that promised impossible returns. The South Sea Company in London offered to assume Britain's war debt in exchange for a monopoly on trade with South America. The stock price soared on pure speculation. Ordinary people, aristocrats, everyone bought in. Then reality hit. The trade monopoly was worthless. Spain controlled South America and wasn't cooperating. The stock crashed. Thousands were ruined. Estates were lost. Fortunes evaporated. But one group prospered. The old banking families, the Horeys, the Childs, the Cootes family. They had lent money during the mania, but they secured their loans with real assets, land, bonds, commodities. When the crash came, they foreclosed. They acquired estates from bankrupt aristocrats at pennies on the pound, and they consolidated their position as the lenders to the crown. The crisis didn't hurt them. It eliminated their competition and made them indispensable. In France, the Mississippi bubble was even more destructive. John Law, a Scottish financier, convinced the French regent to let him establish a national bank that could issue paper currency. Law's bank bought the Compagnie des Indes, which held a monopoly on trade with French Louisiana. The stock price inflated wildly, then collapsed. The entire French monetary system nearly disintegrated, but the old banking networks, the Huguenot financiers, the Swiss private banks, the Genevan families, they had moved their wealth into hard assets before the crash. They survived. And when the French crown needed emergency loans to stabilize the currency, they provided them at extortionate rates. The crown became more indebted. The old families became more powerful. This is Talleyrand. He first clear iteration of the playbook. Profit from the bubble, exit before the crash, then loan money to clean up the disaster you helped inflate. Move forward to the Napoleonic Wars. Europe was burning. Governments needed unprecedented amounts of money to field armies. Tax revenue couldn't cover it. Traditional lenders were tapped out. Enter a network of private banking houses across Europe. Not one family, but a coordinated group with branches in every major capital. They financed both sides. The British government borrowed to fight Napoleon. The Austrian Empire borrowed to resist him. Even some French financing flowed through these networks indirectly. The bankers didn't care who won. They cared about interest payments and the collateral they extracted. Here's what's critical. These banking families positioned themselves as the only source of large-scale credit. Governments had no choice. Borrow from them or lose the war. So they borrowed. And the terms were brutal. High interest, backed by tax revenue, and increasingly, backed by state assets. Toll roads, mining rights, customs revenues. If a government couldn't pay, the bankers didn't just forgive the debt, they took control of the revenue stream. This is the second move in the playbook. Become the indispensable lender, make yourself the only option, then extract not just interest but structural control. By 1815, after Waterloo, these families had financed the entire conflict. The winning side, Britain, owed them vast sums. The losing side, France and Austria, owed even more. But here's the key. The debt wasn't forgiven. It was restructured, refinanced, rolled over. And the banking families that held it now had a permanent claim on European tax revenues. They had turned a war into a generational income stream. The wealth transfer was complete. Governments were locked into paying, and the families that financed the war were now embedded in the state apparatus itself. They weren't outsiders lending money. They were insiders managing state finances, advising treasuries, underwriting new bonds. They had moved from creditors to controllers, now moved to America in the 1830s. The economy was booming. Land speculation was rampant. State banks were issuing paper currency backed by almost nothing. It was a bubble. And the old banking elites in New York, the Astors, the Golets, the Rhinelanders, they saw it coming. In 1836, President Andrew Jackson killed the Second Bank of the United States and demanded that land purchases be paid in gold or silver, not paper currency. This was the specie circular. It triggered a liquidity crisis. Banks couldn't meet withdrawal demands. Credit froze. By 1837, the economy collapsed. The Panic of 1837. Thousands of businesses failed. Farmers lost their land. Unemployment soared. But the New York banking families had positioned themselves perfectly. They held gold. They had liquid assets. And they had cash when no one else did. So they bought land in Manhattan, land along the Hudson, foreclosed properties across the eastern seaboard. They acquired at 5, 10, 20 cents on the dollar. When the economy recovered, those assets were worth fortunes. The Astor family alone accumulated enough Manhattan real estate during the Panic to become one of the wealthiest dynasties in American history. They didn't get rich from innovation or production. They got rich from buying distressed assets during a crisis they anticipated. This is the third iteration of the playbook. Position yourself with liquidity before the crash. Let the panic unfold. Then acquire everything of value while prices are collapsed. It's not illegal. It's not even hidden. It's just ruthlessly timed. Move to 1907. Another American panic. The stock market crashed. Banks failed. The economy seized. There was no central bank, no lender of last resort, just chaos. Then one man stepped in, a financier who controlled a network of banks and industrial corporations. He organized a private bailout. He gathered the heads of the major banks in his library, locked the doors, and forced them to pool their capital to stabilize failing institutions. It worked. The panic subsided. And this financier was hailed as a hero. But here's what happened behind the scenes. The bailout wasn't charity. The banks that were saved owed their survival to him. The corporations that received emergency loans became dependent. And the assets that were acquired during the panic, railroads, steel companies, utilities, they were bought at distressed prices by companies he controlled. By the time the crisis ended, his financial network had consolidated control over a significant portion of American industry. He didn't cause the panic, but he used it to eliminate competitors and expand his empire. And crucially, he used the crisis to push for the creation of a central bank. He argued that the economy needed a permanent mechanism to provide liquidity in emergencies. Congress agreed. By 1913, the Federal Reserve was established, and the structure of the Fed ensured that the largest banks, the same ones this financier controlled, would have privileged access to its credit facilities. The crisis of 1907 became the justification for a system that institutionalized elite access to emergency liquidity. This is the fourth move in the playbook. Use the crisis to change the rules. Get the government to create mechanisms that favor your position. Turn emergency measures into permanent structures, and make sure those structures give you privileged access. Now move to the Great Depression, 1929 to 1933. The stock market collapsed. Banks failed by the thousands. Unemployment hit 25%. Farms were foreclosed. Families lost everything. But a small number of financial families not only survived, they thrived. They had moved out of stocks before the crash. They held cash, gold, government bonds, and they waited. By 1932, asset prices had collapsed. Stocks were down 90%. Real estate was selling for fractions of its value. And these families bought. Industrial companies, utilities, railroads, urban real estate. They acquired at Depression-era prices. When the economy recovered in the late 1930s, and especially during World War II, those assets exploded in value. The families that bought during the Depression became the wealthiest dynasties of the mid-20th century. They didn't create new industries. They bought existing ones when everyone else was too broken to hold on. But here's the darker piece. These families also influenced policy during the crisis. They advised the Treasury. They shaped the bank rescue programs. And they ensured that the institutions they controlled received government support while smaller competitors were allowed to fail. This wasn't a conspiracy in the sense of a secret meeting. It was structural. The people advising the government were the same people who owned the banks. Their policy recommendations served their interests. And the result was consolidation. By 1940, the American banking system was far more concentrated than it had been in 1920. Fewer banks, more power in fewer hands. The Depression eliminated the small players and empowered the dynasties. This pattern repeated in every major economy. In Germany, a small number of industrial and banking families used the chaos of hyperinflation and depression to acquire assets. In Britain, old banking families bought distressed estates and industrial firms. In France, financial elites consolidated control during the economic collapse of the 1930s. The mechanism was the same everywhere: crisis, consolidation, and structural advantage. Now move to the 1980s, the Latin American debt crisis. I mentioned this earlier in a different context, but let me show you how it fits the playbook. Developing countries had borrowed heavily during the 1970s, when interest rates were low and commodity prices were high. Then the Federal Reserve raised rates to crush inflation. Interest on those loans tripled. Mexico, Brazil, Argentina, they couldn't pay. Default was imminent. American banks that had made those loans faced catastrophic losses. So what happened? The banks didn't take the losses. Instead, the US government, through the International Monetary Fund and World Bank, orchestrated a bailout. Public money, taxpayer money, was used to keep the debtor nations afloat just long enough to keep paying interest to the American banks. But the bailout came with conditions. The debtor nations had to privatize state assets, open their markets, and cut public spending. And who bought the privatized assets? The same financial elites who held the debt. American and European investment firms acquired oil companies, telecom networks, utilities, often at rigged auctions or sweetheart deals arranged by compliant governments. The debt crisis became a privatization bonanza. Public assets in Latin America were transferred to private hands, mostly foreign private hands, at fractions of their value. And the debt was never forgiven. It was restructured, extended, made permanent. So the wealth transfer continued. Interest payments flowed north, assets flowed north, and the populations of these countries were left with austerity, unemployment, and collapsing public services. This is the fifth move in the playbook. When the crisis goes global, use international institutions to socialize the losses and privatize the gains. Taxpayers in creditor nations bail out the banks, citizens in debtor nations lose their public assets, and the elite families that orchestrated the loans in the first place acquire the collateral. Now bring it to 2008, the financial crisis. The largest economic collapse since the Great Depression. Banks had made trillions in bad loans, subprime mortgages bundled into securities and sold as safe assets. When the housing market collapsed, the securities became worthless. Banks faced insolvency. The global financial system teetered on the edge. Governments panicked, and they responded with the largest bailout in history. In the United States alone, the Federal Reserve and Treasury committed over $4 trillion to rescue the banks. Loans, asset purchases, guarantees, public money, created out of nothing by the central bank, was used to absorb the losses that should have bankrupted the institutions that caused the crisis. But here's what almost no one talks about. While the banks were being bailed out, a small number of investment firms were buying distressed assets at incredible discounts. Foreclosed homes, commercial real estate, mortgage-backed securities that were trading at 20 cents on the dollar. These firms had cash. They had access to cheap credit from the Federal Reserve. And they bought everything. By 2012, a handful of private equity firms and asset managers owned hundreds of thousands of foreclosed homes across America. They converted them into rentals and created a new asset class, single-family rental portfolios. They turned the foreclosure crisis into a real estate empire, and those portfolios are worth tens of billions today. The families that lost their homes during the crisis became renters, paying monthly to the firms that bought their houses from the banks that foreclosed on them. This is the playbook in its purest form. The banks make reckless loans and get bailed out with public money. The elite investment firms buy the wreckage at distressed prices. The middle class loses wealth, homes, savings, and the top consolidates. More assets, more control, more structural power. And here's the critical piece. The policy response to 2008 locked in this advantage. The Federal Reserve kept interest rates at zero for years. This made borrowing incredibly cheap, but only for those who already had access to credit. The big investment firms could borrow at near zero and buy assets. Ordinary people couldn't. They were underwater on mortgages or couldn't qualify for loans. So, the post-crisis recovery was extraordinarily unequal. Asset prices soared. Stocks, real estate, bonds. If you owned assets, you got rich. If you didn't, you stagnated. And the wealth gap exploded. By 2020, the top 1% owned more wealth than the entire middle class. That didn't happen by accident. It was the structural result of crisis policies designed by people who were themselves part of the elite. Now look at 2020, the pandemic. Markets collapsed in March. Governments locked down economies. Unemployment spiked. Small businesses closed by the hundreds of thousands. It was a crisis, and the response was immediate. Central banks around the world injected trillions into the financial system. The Federal Reserve alone created $5 trillion in a matter of months. They bought government bonds, corporate bonds, mortgage securities. They propped up asset prices, and within weeks, the stock market recovered. By the end of 2020, it hit record highs. But the real economy was still in shambles. Millions were unemployed. Main Street was devastated. Yet Wall Street was thriving. Why? Because the money went to assets, not people. The firms that owned stocks, bonds, and real estate saw their portfolios surge in value. The workers who lost jobs got temporary unemployment benefits, but no structural support. And once again, a small number of elite firms bought distressed assets. Private equity firms acquired struggling retail chains, restaurant groups, real estate. They bought at pandemic prices with cheap credit from the Fed. By 2021, those assets had recovered. The firms made billions. The workers who lost their jobs didn't recover their wealth. They lost savings, cashed out retirement accounts, went into debt. The pandemic was the most rapid wealth transfer in modern history. $4 trillion moved from the bottom 90% to the top 1% in the span of 18 months. And it followed the exact same playbook. Crisis, liquidity for the top, asset purchases at distressed prices, consolidation of wealth and power. Let me show you the exact mechanism that makes this possible. It's not just about having money, it's about having access. The Federal Reserve, the European Central Bank, the Bank of England, they don't lend to you, they lend to banks. And banks lend to their best clients, the largest corporations, the biggest investment firms, the elite families with established credit lines. When a crisis hits, the central bank creates money and pushes it into the financial system, but it flows through banks first, so the people closest to the banks get access first. They can borrow at the lowest rates, they can buy before prices recover. By the time money trickles down to the real economy, through wages or small business loans, asset prices have already rebounded. The opportunity to buy cheap is gone. This is called the Cantillon effect. It's named after an 18th century economist who observed that when new money is created, the people closest to the source benefit most. Prices rise over time, but those who get the money first can buy before prices adjust. It's an invisible wealth transfer, structured into the monetary system. And it advantages the same group every single time. The banks, the investment firms, the families with access to credit. Now here's the institutional layer. The asset management firms that buy during crises aren't small players. They manage trillions. And they're all connected. Overlapping boards, shared investors, coordinated strategies. They don't compete in crises. They coordinate. Not through explicit collusion, but through shared interest and common methods. They all know the playbook. When a crisis hits, sell volatility, buy fear, position for the recovery. They all have access to the same cheap credit, and they all target the same distressed assets. The result looks like coordination even if there's no formal agreement. And because they manage pensions, endowments, sovereign wealth funds, they're investing other people's money. If they lose, their clients lose. If they win, they collect fees. It's asymmetric. They have every incentive to take risk during a crisis, because the upside is enormous, and the downside is spread across millions of passive investors who don't even know what's being bought in their name. Now connect this to political power. The families and firms that profit from crises don't just own assets, they own influence. They fund political campaigns. They endow think tanks. They place their executives in treasury departments and central banks. This isn't bribery, it's structural. The people who understand finance well enough to manage a crisis are the same people who come from the financial industry. So when a crisis hits, governments appoint them to key positions, and their policy recommendations reflect their worldview and their interests. After 2008, the Treasury Secretary was a former investment bank CEO. The head of the New York Federal Reserve had close ties to Wall Street. The architects of the bailout were people whose wealth was tied to the survival of the banks. They didn't design the bailout to harm the public. They designed it based on what they believed was necessary. But what they believed was necessary happened to align perfectly with the interests of their class. The banks survived, the bondholders were protected, and the policy response ensured that asset prices recovered, which benefited everyone who owned assets. This is how the playbook becomes self-perpetuating. The people who profit from crises are the same people who manage the response to crises, and their solutions always involve protecting asset values and providing liquidity to the top. Now, let me show you what this means for the next crisis, because there will be a next crisis. The system is built on debt, and debt accumulates. At some point, something breaks. A sovereign default, a derivatives blow-up, a currency collapse, a geopolitical shock. It doesn't matter what triggers it. What matters is the response. And based on 4 centuries of history, the response will follow the same playbook. Central banks will create money. They'll inject liquidity into the financial system. Asset prices will collapse temporarily, then recover. And during that window, the elite firms with access to cheap credit will buy. They'll acquire real estate, companies, infrastructure, resources. They'll buy from distressed sellers, from bankrupt firms, from governments forced to privatize. And when the crisis ends, they'll own more than they did before. The middle class will own less. Savings will be eroded by inflation. Jobs will be lost. Wages will stagnate. But asset prices will recover and the wealth gap will widen further. This isn't prediction. This is pattern recognition. It's happened in 1720, 1815, 1837, 1907, 1929, 1982, 2008, and 2020. The details change, the assets change, but the structure is identical. Crisis, intervention, consolidation, and every time, a handful of families and firms emerge wealthier and more powerful. Here's what makes it so effective. It doesn't require conspiracy. It doesn't require secret meetings. It just requires position. If you have access to credit, if you have liquidity during a crisis, if you understand the pattern, you can execute the playbook without coordinating with anyone. You just do what's rational for someone in your position. And because everyone at the top is in a similar position, they all act similarly. The result looks coordinated because the incentives are aligned, but it's structural, not conspiratorial. And that makes it nearly impossible to stop. You can't prosecute someone for buying distressed assets. You can't regulate access to credit without collapsing the financial system. And you can't change the pattern without changing the entire structure of money, debt, and central banking. Now, let me be specific about who these elites are today. Not names you'd recognize from history books. Not the families from 3 centuries ago. Some of those families still exist, still wealthy, but they're quiet. The visible players today are asset management firms. The largest control tens of trillions in assets. They own significant stakes in nearly every major corporation. They hold vast quantities of government bonds. They manage pensions, endowments, insurance reserves. They are the new elite. Not individual families, but institutional networks. And they operate the playbook at scale. When 2008 hit, they bought mortgage securities. When 2020 hit, they bought corporate bonds and real estate. When the next crisis hits, they'll buy whatever's cheap. They have the cash, the credit, and the access. And they have the political connections to ensure the policy response supports asset prices. Here's the mechanism that makes this 영속된 이 지속돼. Sustainable permanently. These firms don't just own assets, they own the debt, they hold government bonds, they hold corporate bonds, they hold mortgage-backed securities. So when a government borrows to fund a bailout, these firms are the creditors. The government borrows money, spends it to stabilize the economy, and pays interest to the bondholders. The bondholders are the same firms that bought distressed assets during the crisis, so they profit twice. Once from buying cheap assets, and again from the interest payments on the bonds the government issued to fund the bailout. It's a closed loop. The crisis creates the opportunity, the bailout creates the debt, and the debt pays interest to the people who profited from the crisis. This is why the system never changes. The people who would need to change it are the people who benefit from it. And the people who suffer from it don't have the power to change it. Now, what does this mean for you? You're not going to be invited into the inner circle. You're not going to get the call from the central bank offering cheap credit. You're not going to be at the table when the bailout is designed, but you can see the pattern. And once you see it, you can make different choices. You can understand that crises are not random. They're structural. And the response to crises is predictable. Liquidity flows to the top. Assets get bought at distressed prices, and the wealth gap widens. If you understand that, you can at least protect yourself. You can avoid being the distressed seller. You can avoid over-leveraging. You can hold assets that survive crises, real assets, not just paper. And you can recognize that the system isn't designed for your benefit. It's designed to transfer wealth upward during moments of chaos. That's not cynicism. That's 400 years of documented history. The elite playbook isn't hidden. It's just ignored. It's taught in business schools as crisis management. It's celebrated in financial media as smart investing. But it's the same method refined over centuries. Create or wait for instability. Position with liquidity. Let the crisis unfold. Provide the solution at a price. Acquire assets while they're cheap. And lock in structural advantages that last for generations. The families that perfected this are wealthier today than they were a century ago. Not because they work harder, not because they innovate, but because they execute the playbook every time the cycle turns. And the cycle always turns. Debt accumulates, instability builds, crisis erupts. And the people who understand the pattern profit while everyone else scrambles to survive. If this changed how you see financial crises, if you now understand that crashes aren't accidents but opportunities for those positioned correctly, then you're beginning to see the architecture of power. Subscribe if you want to keep tracking these patterns because they're accelerating. The crises are coming faster, the bailouts are getting larger, and the wealth transfer is becoming more extreme. The elite playbook hasn't changed in 4 centuries, but the scale has, and unless you see it clearly, you'll be on the wrong side of the next transfer. The families at the top aren't worried about the next crisis, they're preparing for it. And when it comes, they'll do exactly what they've always done. They'll buy everything you're forced to sell. That's not a threat, that's the pattern, and the pattern doesn't break, it just repeats.